Hello, Malcolm.
Hey there.
Hey, we're getting some traffic. Welcome to the second class, I guess you call this. Hi, Byron. How you doing? You're muted.
Can you hear me now?
Now I can. Hi, welcome aboard. It's Byron, right?
Correct.
Hi, Justin. Welcome back.
How's it going?
Good, good. Hi, Malcolm.
Hey, how you doing?
Good. Does anybody else want to show their face, or just gonna be me and Byron on screen tonight?
Yeah, I'll hop in 1 second.
All right, Malcolm.
Driving down the 101, so I will not have my video on.
Drive carefully. Okay, Malcolm's going to show his face, right?
Yeah, just throwing a shirt on real quick.
Thank you for that. With this pandemic, so many public figures are getting in trouble on Zoom meetings. Hi, Malcolm. How you doing? Welcome back. Okay, guys. I guess we'll start with, we'll go into chapter 1 again. I don't know if you looked at the video from the meeting the other day. We'll get into chapter 1. We'll cover some basic things. We'll go over chapter 2 a little bit too. And then Saturday, we'll hit chapter 2 real hard and maybe even get a start on chapter 3, okay? Byron, did you take accounting 110?
I did not, unfortunately.
Okay, how about you, Malcolm? Did you take 110?
I did not either, no.
Okay, well, I mean, that's fine. It just gives me a starting point here. Okay, so what we'll do is we'll have our video meeting here. This will then go up in Canvas and it'll be on my Bob Smagula YouTube channel, along with all of my other stuff that might be helpful, all right? So let's see if I can share the screen. Do you now see a PowerPoint there?
I do.
Okay, we have one I do, so I think that means we all see it, huh? Okay, give me 1 second to make it big for my eyes. Custom slideshow. Okay, guys, chapter 1, go over it in a little bit of detail, pointing out the things that'll help you study, huh? Chapter 1, the accounting system. The accounting system can produce GAAP reports, meaning generally accepted accounting principle reports, which is the financial accounting reports on the left. This side here, this is what we're doing in this course. We're doing audited financial statements that are prepared according to generally accepted accounting principles. And they're done through a set of those principles, which are hard and fast, meaning when the auditor tells the world that this company's statements have been audited and they say they have been done according to generally accepted accounting principles, creditors, like a creditor is a lender can then make a judgment whether you're creditworthy. He wants to see your financial statements to make sure you will pay him back. Investors want to know about it in case they want to buy the stock in your company. Managerial is accounting 240. So we are financial accounting. Here are 3 types of cash flows, if you will. We have a big chapter just on this much later in the course, but for purposes of this class and preparing for the first test, let's just understand what the 3 cash flows are, the 3 business activities: operating, financing, and investing. Operating. In this chapter, in this book, for the most part, we are Nordstrom's. We are a department store, okay? Well, I don't want to say Kmart, they're gone, but you get the idea, Target. Operating activities simply means the things the company normally does to sell its product. For example, Nordstrom sells merchandise. So their operating activities would be buying the clothes that they sell. Their operating activity would be paying their employees, paying the electric bill, selling things to customers, collecting, paying bills, etc. Whatever the business does to stand alone. Investing is really 2 things. It's basically buying a big piece of equipment that's going to last a long time. a big cement mixer, or in the case of Target, say, a big building somewhere that they convert into a store. Investing. Financing is simply borrowing money, okay? Obviously, when we're talking cash flows, I'm using the word cash flows the same as business activities. We want to see the big cash flows positive under operating activities, okay? We're going to take a peek at the financial statements now. They have to be done in a particular order, not this order. You start with the income statement. I think we can understand the income statement pretty quickly. The income statement is just like it sounds like. It tells you your net income. It is the sales or your revenues minus your expenses, okay? I mean, that makes sense. Target buys some kind of toaster for $25 and they sell it to you for $60. Well, they made a profit of that difference for what, $35. That's a simple income statement I just gave you. Once we know the income, we now have to take that income at the end of the month and use it to increase what's called the stockholders' equity. Stockholders' equity or stockholders' capital, or just capital. This here, stockholders' equity, is the net worth of the building of the company on paper. And this report is going to take the beginning number. It's going to add the net income and subtract something called dividends that we might give out. Statement of cash flows, let's ignore that because that's not going to come up other than very basic at the beginning. All right, here's the first thing you have to know, like your own name, huh? The accounting equation. Assets equal liabilities plus stockholders' equity. Assets equal liabilities plus capital. Assets equals liabilities plus equity. Your company has assets of $1 million. And we know it's a good number. We know it's an accurate number. I'm looking at your financial statements. Does that mean that I would give you $1 million for that company? Probably not, because this company has liabilities, like every company does. A liability is a debt. It's a payable. It's an IOU. It's how much money you owe to people you buy from, people you may have borrowed from. This here is a debt, a liability. So this company could have $1 million worth of assets, and the owner comes to you and says, I'll sell you my whole company for $10,000. I have $1 million worth of assets. But what if he has $1 million worth of liabilities? Then the company is worth zero. Assets minus liabilities will equal stockholders' equity. This is called the accounting equation once again, and it must always remain in balance. And that's what we're going to practice a little bit later here, okay? The accounting equation must always be in balance. I don't think you're ever going to have that problem with modern computer power and the PCs and programs like QuickBooks. In the old days when we did it in pencil, yeah, you could get all fouled up. We know what an asset is, huh? An asset. Anything that's good to own, that's going to provide benefits for us, huh? There's no better asset than cash. Cash. Maybe we bought stock in another company or a bond. Accounts receivable. You're going to hear that a lot, the whole course, accounts receivable. That's the number representing how much customers owe you at that point in time. If the accounts receivable at the end of the month was $800,000, you would see a list of customers and their debt to you adding up to that. And then we have the other things we'll go into, the long-term type investments, your buildings and land and things. Accounts receivable. If accounts receivable represents how much we are owed from our customers, accounts payable is the reciprocal. It's the opposite. Accounts payable represents the amount that we owe to our suppliers. Our suppliers, that's classic operating. Notes payable would be borrowing money. We may have borrowed money. And then the equity has a couple of sections we're going to go over here. A company will issue stock to the world, and when they make money, it increases this stockholders' equity through this component of it. Let's take a look at your first balance sheet, huh? Up ahead on top here, assets equal liabilities plus equity. So this is Nature's, and this number here is 527 million, I guess, but we'll call it what it is, 527.4 total assets. Man, they have a ton of liabilities though, you see that? 407, so this business is only worth the difference between those two numbers, which I can't see right now, this thing is blocked, but you can see the total liabilities and equity equal 527.4. So there's your balance sheet. This is the financial statement, one of the financial statements that goes out to the world. Your auditors will come in. I'm talking about the CPAs, the independent external auditors, whose charge is to come to your business and verify that these numbers are correct based on their practices. For example, they'll come in and say, how much you have in accounts receivable? Well, this company looks like it really has 6 billion. That's what that really represents with the millions. So they're going to say, we have almost 7 billion. And they'll say, show me on your ledger. You'll see it on the ledger, and then they're going to go and contact your customers. And this is the starting point for the auditors. Okay, here's the income statement. This is what we were just talking about. Sales minus expenses. That's the simplest way to understand it. Sales minus expenses. And we can call them revenues, sales revenues. You know, maybe you charge fees. Maybe you're some kind of nightclub or something and you charge a fee. Maybe you loaned money to people and they owe you interest. Maybe you rent out some properties. Different types of revenue. Revenue and sales, pretty much synonymous. Revenue and sales, synonymous. These are different types of expenses. And I don't think you needed to come to this class to know that companies have wages to pay, salaries to pay. They may pay rent. They may have borrowed money, depreciate equipment, et cetera, et cetera. I call your attention to cost of goods sold. This is one where the students have a little trouble picking it up at first. So I'm going to talk about it just briefly now, and we'll keep reinforcing it. Cost of goods sold is an expense which represents what you paid for the item you just sold. Target sold that toaster for $60. $60, that's the sale. They paid $20 for that toaster from the wholesaler. That's the cost of goods sold, what you paid for the item you sold. It's nothing more than that. It doesn't include anything else. Look at their income statement. Let's see what they have on the income statement here. Well, they have revenues of 275, and notice the heading is pretty standard. You have to have the company name, what the statement is. For the year ended is very important, and we'll explain why that is. And then they translate the money for you. A big company like this, it's much easier to just show $275.1 and remind everybody you got to put 6 zeros after that to get the right number, okay? So this is a pretty darn big company from what I can see here. I never heard of them, to be honest with you. Sales revenue, here's the cost of goods sold. These guys sold energy drinks, health drinks for $275, and they paid, excuse me, get the happy fingers once in a while. The cost of goods sold is what they paid for those drinks. And then you see expenses, selling, general, and admin. That's all your other operating expenses. Looks like they borrowed money and they got to pay that back. So their profit before taxes was 40, and they make a profit of 22.9. So we look at the balance sheet. We looked at the income statement. The balance sheet was a representation of the accounting equation, if you want to start learning it that way. Income statement, sales minus expenses. Now here's the report we do in the middle. This is another financial statement that goes out to the world. This is called the statement of stockholders' equity. And let's understand that stockholders' equity is what the business is worth on paper. It very, very likely has nothing to do with what it's worth in the marketplace, for reasons you'll be learning pretty soon. So this statement works as follows. You go to the end of last month and find out what the beginning balance was. You add the income for the month. You subtract any dividends, and you get the ending retained earnings. Let me explain what retained earnings means. Retained earnings are zero when the business begins. It's part of your equity. So when this company began, perhaps 50 years ago, they issued stock to the public, and they ended up with getting $1 million in cash, and the equity was $1 million. That's all they had, no retained earnings. If they made a profit the first year of, say, $1,000, that profit, as we just see here, has to be added to the equity, and it's done through this component of it called retained earnings. So they have 1,000. They make a profit of 9,000 the next year, it goes up. So think of retained earnings as all of the profits and losses of this company added up and subtracted for the years they might have lost money to the present day. So this company, if this number was $1 million, it means that since the company began, they made money, lost money, until it finally added up to this number. That's what retained earnings is. So every month, we have to take that net income number from the income statement, add it. If they give out dividends, that comes out of retained earnings too, because that's giving away part of the company. I happen to like a few mnemonics, little teasers that might help you remember. With this report, you got to bide your time. You know that expression, bide your time, BIDE, beginning, income, dividends, ending. That's all this report is. So don't get rattled by it. Students tend to say, oh man, I understand the income statement and I kind of understand the balance sheet because it's the accounting equation. This is the one that brings the two together into your equity. Here's an example of it right here. At the beginning of this period, as at the end of 2011, they had 55 million in stock. That's how much they issued to the world. And they got 55.7 million, assuming they never, did anything else. So that number is never going to change unless they issue more stock. What is going to change? Retained earnings. So this period, they made that profit of 22.9 we just looked at, and they were nice enough to give out $2 in dividends. So their equity went from 55 plus this is about almost 100, went over that. The two columns added together represent your total equity. So that's just a quick poor man's look at the financial statements. Again, we're not going to do much with the cash flows for the first part of the course, other than knowing the difference between what's operating, which is your normal business activity, what's investing, you bought a big piece of equipment, or you bought stock in another company. Financing is simply borrowing, okay? We just need to know what they are. And let's take a look at a real simple, summarized, matchbook-sized cash flow statement. Well, let's see here. The cash balance at the beginning of the year was 1.6, and at the end it grew to 10.6. So they picked up $9 billion, okay? So the boss comes in and he said, $9 billion. He said, gee, I thought we did better than that. He said, wait a minute. From operating, we generated almost $88 million. The boss will say, what's going on? What'd you guys do with my money? And you have to remind the boss, hey, boss, don't you remember when we had all this money, we went out and we bought that new building in, South America? And the boss, oh yeah, I forgot about that. Financing means they borrowed money. So that's what the cash flow statement does. It tells the world how much the cash changed from period to period and why. So that's all I think we need to talk about. This is a very nice slide in your book, I think. This is kind of a good graphic. Remember we said this stuff has to be done, I don't want to say stuff, these statements must be done in the proper order. They cannot be done otherwise. You do the income statement first, revenues minus expenses, and then you come over here to bide your time with the equity. You take the beginning equity plus the income minus any dividends. Okay, so this company went from 43, so they went up about $21 million. Once you have, once you have this report done, now you're ready to do the balance sheet, and you're basically just going to copy every one of these numbers except for one, the retained earnings. That's the only one that's going to change from the end of the month prior to the start of the new month. And again, cash flow statement. So understand these relationships here. This is kind of the flow at the end of the month, okay? Did you notice a sentence at the bottom of each financial statement? I didn't notice, did you? I don't see any sentences. The point I want to make here is that when you look at a company's financial statements, you call up their annual report or the annual 10K, which is the required reporting of financial statements to the Securities and Exchange Commission, you'll see notes all over the place. All financial statements should be accompanied by notes, which provide the reader with supplemental or extra information about the financial condition and results of operations of the company. An example might be something as simple as accounts receivable. Accounts receivable. They're going to point out, well, these are accounts receivable, but we have a bad debt allowance that really we think is going to reduce that. And they'll talk about maybe they had a shift in their customer base. They'll say something like receivables stayed the same, even though US sales went down, but it was offset by sales overseas. So the notes are really, really important. And here's another grid if you want to look at it, presenting the same information. I call your attention to structure. Balance sheet equals the accounting equation. Income statement, BIDE for stockholders' equity. Okay. It's a lot to chew up in one class here, but we'll keep going. Generally accepted accounting principles, GAAP. These are the rules of accounting. These are the rules that say, here is when you can record the sale. Here is when you can record the expense. Here is how you value a particular item on your financial statements. And this book is gigantic, all these rules. And they come from what is called the Financial Accounting Standards Board, FASB, and that might pop up on the test, these couple of acronyms. Financial Accounting Standards Board, that is the division of the certified public accountants that have been empowered by the Securities and Exchange Commission to prepare statements, okay? So they set the rules. Did you know accounting was invented by a priest back in 1494? Believe it or not, I actually stumbled across this guy's biography at a used bookstore, and for $2 I bought it, and it was quite interesting. Anyway, prior to 1993, the management teams of most companies were largely free to choose their own financial reporting and how they did it. I mean, it was crazy in those days. You would go on the New York Stock Exchange and you would see a stock that was going up, and then you'd look at their financial statements and they were reporting they were doing great. They could have been lying to you. And it was a big part of the Great Depression, because throughout the 1920s, people who worked at low-paying jobs, say a waiter, not insulting waiters, but somebody who doesn't make a lot of money, they were millionaires on paper because they kept buying on what's called margin. The stock would go up and up, and the stockbroker would say, okay, you don't have to pay $100 a share, you only have to pay $2. But then when the stock went up, you sold the stock and made your profit. That was the theory. Of course, that could have never lasted. And in 1933, after President Hoover was voted out, Franklin Delano Roosevelt became president, and his administration started the Securities and Exchange Commission. And going back to the priest, notice that this accounting system began in 1494, 2 years after Columbus discovered America. After he discovered America, business was being done all over the world. They needed to keep track of it, okay? Like I said, the Securities Exchange Act of 1933 gave broad powers to determine the rules. The SEC, you've heard of the SEC. If you have a company and you hope to list it on the New York Stock Exchange or the over-the-counter or whatever, you must prepare your financial statements plus other non-accounting things according to the SEC. It gives the investor, the lender, confidence that when they see these financial statements, they may not be accurate, I'm not saying they're accurate, but they have been prepared according to GAAP, generally accepted accounting principles, okay? FASB, just some things we need to understand. Generally accepted accounting, companies incur the cost of preparing the financial statements and they bear the following consequences. Only one person and one person only is responsible for the accuracy of the statements. Management of the company. Management. The auditors, the only thing the auditors can do is take the information you give them and try to verify it to to the best of their ability. Cash. You tell the auditor you have $1 million in cash when you have zero. The auditor says, okay, who's your bank? You give them the bank and you and the bank are in cahoots. The bank says, yeah, we got $1 million here. That's the type of thing that management is responsible. So management bears these consequences, the effect on the selling price of the stock. Companies announce their results every quarter. And depending on those results, the stock price might move. What happens to bonuses? Bonuses. You know, where I worked for quite a while, for a little while, we paid our commissions to our sales force on the basis of sales. Well, that sounds like a good thing. The more they sold, the better. Not necessarily, because they would sell the high priced item that might give us a lower profit than something else. In other words, they would sell something for $1 million, but the cost of it was $900,000. We only made 10%, $100,000. If they had sold more of the $700 items, we would have done much better. And also competitive information, huh? Don't worry about international. We do nothing in international here. And I'm just going to talk briefly about ethics. Ethics. Doing the right thing, huh? We want to be ethical. We want to behave as good citizens. We don't want to find ourselves being perp walked out of an office into jail. So we want to say to ourselves, identify what happens with this accounting decision, who's involved and who's going to be harmed. Think about it. Think beyond the numbers. And then after you've done that, think of maybe a better way to do this. Is this the only way we can handle this? And then finally, use your conscience, I guess is what they're saying. Choose the choice, the action that you would like your family and friends to see if it was on the local news, okay? To ensure accuracy, to ensure the accuracy of the financial statements, companies employ what is called internal controls. Internal controls, system of controls. Cash, a simple control is you lock the money in a safe. Another control would be having different people handling the cash so not one person is doing everything. You have independent external auditors. External. They're the ones who come in, use their expertise, and they have the power to give you their opinion, a very formal opinion, okay? Companies have internal auditors, and they perform a very useful function, but they're not independent, so the public can't believe them. And we have a board of directors, huh? So internal controls, audits. An audit is an examination of the financial statements to ensure They represent what they claim and conform with GAAP. And this woman here, one of the auditors, said, overall, I believe these statements are fairly stated. The auditors are not claiming that the numbers are correct for the most part, believe it or not. They take what you give them and they do their best to audit it. If a company is trying to fool around, deceive the public, if the auditors made a good due diligence effort to prepare their audit, they're not responsible. Management is. Management, okay? External auditors. This is kind of interesting. Remember we were working with that drink company, La Nature? That's what we saw. Remember their financial statements? They made the profit, I think it was of 22.9 million. After it was determined that the financial statement for La Nature's were misleading, the consequences were as follows for severe. So look what happened to these people. The president, the CEO, the chief executive officer, this guy, he's in jail for 20 years, 15 years, 10 years. I've never heard of this company, nor have I ever looked them up on the internet, but look what happened to them when they finally got caught. So these guys got hurt, they're going to jail, but think of the thousands and thousands of people who relied on those statements and lost everything. We'll finish up here. We'll finish up in a few moments here. We are going to look at different types of business activity, different business types. Sole proprietorship, partnership, corporation, advantage of a corporation, like I said, limited liability, continuity of life, ease of transfer of ownership, opportunity to raise money. Corporation, the company screws up, they make a bunch of terrible, stupid decisions, as many corporations do. They go out of business and they can't pay their debts. The management team is not going to jail. You can sue the corporation for whatever assets may still be there, but management isn't going anywhere. Corporations go on forever, and it's they get a little bit of a double taxation. They get taxed on their profits and then on the dividends later. Partnership, 2 or more people, one person dies, whoosh, that's the end of the partnership. Partnerships. I think you might find this interesting. Partnerships are typically in the area of accounting firms, law firms, architects, people like that. And one of the reasons I think is partners have unlimited liability unless they set up a special kind of partnership. But let's assume a CPA firm has unlimited liability, meaning that if one partner screws the company up, all the other partners could be sued personally. And one reason accounting firms have traditionally been partnerships is that's their way of demonstrating, I think, to the public that they're not worried about that because we do things properly. Sole proprietorship, one person, you run the whole show, lots of liability though. That's the end of chapter 1, okay? We've been here about a half hour. Let's do a little bit, okay, guys, in chapter 2. You get your money's worth today, I hope, huh? So I'm gonna try to share chapter 2. And we'll go through this more quickly than we did chapter 1 because we're going to go over chapter 2 in more detail on Saturday, huh? What happened to my cursor? Where is my cursor? Oh, for heaven's sake. No, it must be there, huh? Oh, there it is. I found my cursor. Okay. Chapter 2, let's look at a few transactions and how they affect the accounting equation. And we'll get an introduction to the general ledger, huh? Understand the business, to understand amounts appearing on the balance sheet. What activities cause changes? How do they affect balances? How do they keep track of things? Okay, so we'll get started here. The conceptual framework. Ugh, I'm skipping that. Anytime I see a slide with that much stuff in it, I'm inclined to go back to it. It's too much. It's too busy. Plus, I've read it. It's not terribly helpful. Look at your balance sheet. Assets equal liabilities plus equity. I call your attention to this language. What is an asset? According to your textbook, it's an economic resource with probable future benefits owned or controlled by the entity measured by the historical cost principle. That's a bunch of jargon. An asset is anything we own of value that's going to help us generate profits, okay? Liabilities are debts. We know that. And the difference would be the value of the company. Company has $100 in assets and they have $30 in liabilities. That company on paper is worth $70. Now, Chipotle. Chipotle, huh? Everybody likes Chipotle. And this is one of their actual balance sheets from the end of 2011. And this is in thousands of dollars, not millions. So Chipotle had $401 million of cash. So I'll let you look at this when you're doing your Learn Smart, you're going through the book. They're giving you kind of definitions of what these things are. Accounts receivable, how much customers owe us. Accounts payable, how much we owe to our suppliers. Supplies of the food, the beverage, packaging. They have prepaid expenses. So here is their balance sheet. External transactions. That's what we're talking about here until chapter 4, when we're going to do some internal. External, we're dealing with outside people. Internal are the adjusting journal entries, or in this extreme example, they had a fire damage to the company. So the company had to go out and, spend money to fix the factory. That had nothing to do with, their suppliers or customers. We're going to hit some real basics now for just a little while. Accounts. If you look I believe in the back of your book, the back cover, you'll see 2 pages of what's called the chart of accounts. The chart of accounts. Think of each of these accounts as a folder. Companies want to keep special track of cash, equipment, inventory. The chart of accounts can differ from company to company depending on the business, okay? These are very normal. Let's take a peek here. They're giving you more definitions. This is kind of worth looking at. I'm not going to go through it now. Assets equals liabilities plus equity. I can never say that enough. And the reason they're showing revenues and expenses out here is that revenues minus expenses equals the net income. And then all of this is going to be zeroed out and brought over to retained earnings. So this is their chart of accounts, cash, accounts receivable, etc. It goes in order: assets, liabilities, equity, revenues, and expenses. And you'll learn that immediately when you start doing some of these, okay? Every accounting transaction has to have two what? 2 of these guys. You can't have one. You just can't go into your financial statement and say, all right, we spent money today, so I'm going to decrease cash. Yeah, but what did you get for the money? You have to have that side of it too. That's why they call it double entry accounting. You must have 2 debits, one debit, one credit. We're not there yet with debits and credits. 2 items on the chart of accounts. And this accounting equation, assets equals liabilities plus stockholders' equity, must always be in balance. Must always be in balance. Now, you can look at this yourself and see if this helps you. But basically, what you're doing all month is something happens, and you got to record some financial information. You have to figure out what accounts are affected, which 2, understand if it's a liability, if it's going up or down. This is kind of more of a thought process. I'm going to just kind of go through this a little bit. What accounts? What type of account? Do we have an increase? What are the rules? Blah, 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 blah. Let's just look at a couple of transactions, just a couple. Chipotle issued 10,000 shares of common stock, a penny a share, par value a penny, and the public gave them $62,300,000. These are the accounts they're working with right now. So take a look at cash. It went up 62. This is when the company began, we'll say. Cash went up 62. And common stock went up 100. It was 10,000 shares times the par value. You'll learn that common stock's always a multiple of the par value, and any difference goes into this other equity account. So equity has gone up 62.3. or rather cash has gone up 62.3, equity has gone up 62.3, and we're in balance. Look at a couple more. They borrowed money from a bank. Borrowed money. Well, guess what? When you borrow money, cash goes up. Who knew? What they owe now, that's now a debt. It's called notes payable, not accounts payable, notes payable. So we do these transactions, and let's just do one more. Chipotle purchased new ovens, counters, etc. They paid $55,000 in cash, with the rest to be paid later. So let's take a breather here. They bought equipment that is valued at $63,100. That's how much they're paying for. They bought some ovens, like they said, or whatever. $63,100. The wholesaler or the seller of the hardware said, you have to give me $55,100 now, and then you pay the $8,000 later. So let's take a peek. Now our cash went way down, equipment went way up, and so did the difference in accounts notes payable as a debt. So they take us through various transactions. We'll go over these more in detail on Saturday. What I would like to do is take us to what happens at the end, okay? This is kind of a repeat. Okay, now we're going into T accounts. And I think that is enough for our first online session, okay? We are meeting 3 times a week. And I'm respecting your time. I know you're going to be studying, but look at the end here now. Here is our accounting equation. We're still in balance. Cash went down by 51.6. This went up by 39. We invested money in another company. There are those ovens. Looks like we bought stock or bonds in another company. We issued dividends. We borrowed that money, and we are in balance. And what we will learn on Saturday is what we do with those balances. And the answer is we're going to create a report called the trial balance. These are all your balances. We create the trial balance, and then we use that to prepare the financial statements, the balance sheet, and other things, okay? So I think to me, that's enough for one time. What do you think, Malcolm? Any ideas?
Yeah, that was super helpful for me, but
questions?
nothing too specific. Yeah, no,
Okay.
not here.
Yeah, at this point, it's all brand new. And like I said, I'm obviously driving you nuts with that accounting equation, but that's kind of where we start. Hi, Sandy. Anything you want to add to this?
I have a question about the relationships between the statements.
Very good.
So if you go to that graphic in chapter 1, I think.
Okay, let me get into chapter 1.
While you look it up, the statement of stockholders.
That's not our class. I pulled up the wrong chapter 1. I'm sorry. Hold on.
The statement of stockholders' equity has the retained earnings.
Yes.
It goes to the balance sheet.
Yes.
Why doesn't the common stock also goes to balance sheet? So why isn't that like an arrow, or why isn't that noted? Or
well, let's see. You stop me when you want to look at the relationship here.
there. So
this one?
Yeah. So relationship number 2. The ending retained earnings goes to the balance sheet.
Right, as part of equity. Yes, go ahead.
But right above that, the common stock. That's
part of equity as well.
So, but there's no arrow. Is there a reason why they only emphasize the retained earnings?
What a darn good question. No, I guess what they're saying is they're pulling both items over.
Oh, but
great.
So,
believe me, a really good question though.
But the reason I'm asking is since they pull both numbers down.
Right.
And then in one of the homework questions, I think I did that. I added the common stock and the retained earnings into retained earnings. So like I double counted.
Yes.
But there's a line item that's also common stock. So
yes.
It caught me off guard. Like I was I double counted and I was like, what's going on? Where am I getting this wrong?
Yeah,
And
yeah.
I don't know why I didn't, there's no arrow. I don't know. It's just, I wondered if there's a
You know,
reason
if,
why.
without seeing it, I mean, I can ask if you want to hang on and share it with me. I don't know if you have it in front of you.
Well,
Able to,
I figured it out. It's two
Okay.
line items. The balance sheet has two line items.
yeah, equity, what
Common
you're gonna,
stock,
yeah, go ahead.
It has the common stock and retained earnings.
And you know what else
So-
it has? Additional paid in capital.
Oh, yes, of course. Yes, of course, in chapter 2. But and in chapter 1, it was
Yeah,
those two line items. And
Yep.
then I double counted and then I couldn't figure it out until I figured it out.
that's good. That's good. That was an interesting question. Yeah. You know, they're bringing everything over, the 55.7. Common stock, just remember that is always just a multiple of the par value, nothing else. It has nothing to do with income or dividends.
Right.
It's
Yes.
part of equity. And I'm just pointing that out because your chapter really doesn't go into that. Did you notice that I didn't see once anything in this chapter, at least, about additional paid in capital? But I think they have a problem like that, or a question in chapter 1 anyway. And that causes a little bit of confusion.
I don't remember. I know
Yeah.
they do it in chapter 2.
Gotcha.
My question basically, I wanted to know why this relationship graphic doesn't have an arrow from common stock to common stock. I don't know if there was a reason.
These, when I send these videos out, I don't put them on, I put them on my YouTube channel. And of course, Cornelia will put them in Canvas. And sometimes I'll make a note. And that's a pretty good question here about the 55 coming over. Because if you have that questions, other people are going to have it as well. But does that answer your question?
Yeah. I mean, it does. They both items come down to the balance sheet.
Yep. Yep.
Not just retained earnings. Yes,
Yeah,
thank you.
Yeah, they could have set this thing up a little more clearly. They could have said liabilities and then skipped the line and put a heading down called stockholders' equity and then show the two components of it. That would have been a little clearer. So, all right. Anything else you got, Sandy?
No, that's all. Thank you.
Anybody here a sportsman? Malcolm, Sandy? No?
mean,
Yeah.
I think
Yeah.
we talked before, right, Malcolm?
No, I believe this is our first time.
Yeah. Hey, I'm a big sports fan. I'm from New Jersey. The New York Jets may not win a game this year. New York Giants will be lucky to get another win.
Yeah.
Those two teams could end up losing 15 of 16 games. And you do know they play in New Jersey, not New York, right, guys? Now you do. That's
Yeah,
where,
now I do.
yeah,
Do
that's
they
where
play
Giant
today?
Stadium. Pardon me?
Do they play today?
Well, they're going to be playing Sunday. The Jets actually
Sunday.
playing a team they might be able to beat, but the Giants are dreadful. So, all right, this is where my boss Cornelia gets mad at me when I start babbling at the end. I'll let you guys go, okay?
Thank you. Have a good
know-
evening.
You too. You know where to find me, guys. Good night.
All right. Thank you. Bye.
You're welcome. Good night.